Is the S&P 500 set to plunge 30%? Insights from a 100% accurate forecasting tool. Prepare for a shocking forecast. The S&P 500 might tumble by a whopping 30%. And here's where it gets controversial. But first, let's recap the roller coaster ride of 2025. It's been a wild year for Wall Street, with the S&P 500, NASDAQ Composite, and Dow Jones Industrial Average experiencing dramatic fluctuations since the beginning of 2025. In early April, the market took a nosedive, with the S&P 500 recording its fifth worst two-day percentage drop since 1950. However, just 1 week later, all three major stock indexes saw their largest single-day point gains in history and have continued to rally since then. The S&P 500 has surged by more than 25% in just 3 months, marking only the sixth time in its history to do so. The NASDAQ Composite has surpassed 21,000 for the first time, and the Dow is just 4 points away from an all-time closing high as of July 23rd. With the excitement around AI, and President Donald Trump's administration securing key trade deals, it seems the stock market is unstoppable. But appearances can be misleading. A time-tested valuation tool sends a warning. Before diving into forecasting tools, let's remember that nothing is certain on Wall Street. Predictive tools and correlative events, even those with a 100% accuracy rate in the past, cannot guarantee future outcomes. However, a forecasting tool with a perfect historical success rate in predicting future stock returns deserves attention. The S&P 500's Shiller P/E ratio, also known as the cyclically adjusted P/E ratio or CAPE ratio, stands out among the potential threat to the stock market. Unlike the commonly used price-to-earnings P/E ratio, which can fall short with growth stocks and during recessions, the Shiller P/E ratio provides a more reliable apples-to-apples comparison for investors. The Shiller P/E ratio is calculated using the average inflation-adjusted earnings per share (EPS) over the trailing 10-year period, minimizing the impact of economic shocks. As of July 23rd, the S&P 500's Shiller P/E ratio was at 38.79, making it the third pricest continuous bull market less than 7 years of the previous cycle period since 1950. When back-tested over 154 years, the Shiller P/E has exceeded a multiple of 30 only 6 times, including the current situation. Historical precedent suggests trouble ahead. Following the previous 5 instances where the Shiller P/E top 30, the S&P 500, NASDAQ Composite, and or Dow Jones Industrial Average experienced declines ranging from 20% to 89%. Extended valuations have not been well received by Wall Street over the long term. Moreover, none of these significant pullbacks resulted in the S&P 500's Shiller P/E being higher than 27. Therefore, the minimum historical expectation is for the Shiller P/E to retreat to 27, implying a potential 30% drop in the S&P 500's value. Time in the market trumps timing the market. While the prospect of a substantial market decline may unsettle investors, history shows that time and perspective are on the side of patient investors. According to Crestmont Research's data, every rolling 20-year total return, including dividends, for the S&P 500 has been positive since the start of the 20th century. This means that if an investor bought an S&P 500 index fund anytime between 1900 and 2005 and held onto it for 20 years, they would have seen a profit including dividends 100% of the time. Moreover, the data from Bespoke Investment Group reveals that the average duration of bear markets is less than 10 months, while bull markets last approximately 3.5 times longer. More than half of S&P 500 bull markets have lasted longer than the longest bear market since the Great Depression, which endured for 633 calendar days in the mid-1970s. If the Shiller P/E ratio accurately predicts a 30% decline in the S&P 500, long-term investors should view it as an opportunity to invest for their future, knowing that history and time are on their side.